And there you have it, the closing bell at the New York Stock Exchange. U.S. stocks turned positive in a back-and-forth session following the release of the latest GDP report and the Federal Reserve's decision to raise interest rates by 0.75 points. The Dow Jones ended the day up more than 300 points.
The S&P 500 and tech-heavy NASDAQ advanced around 1%. And joining us for more on all of this is Greg McBride. He's the chief financial analyst for Bankrate.com. Greg, welcome. Great to see you. So what drove the market higher today?
You know, there's a little bit of bad news is good news in the sense that the evidence that the economy is slowing, the negative GDP number for the second quarter, as well as some of the more recent data points, has this belief that the Federal Reserve is going to have to stop raising interest rates sooner, or that they're at the very least going to be tapering off the pace at which they do these instead of these 0.75 percentage point chunks that they've taken at each of the last two meetings. Another big contributor, this is earnings season. This is that time every quarter when companies announce their second quarter results. There was a lot of trepidation coming into earnings season about, oh man, are these going to be bad? Are they going to give us horrible guidance going forward? And it really hasn't been nearly as bad as feared by and large. And so, you know, both of those underpinning pretty strong rally the past couple of days.
So the latest GDP report shows the U.S. economy shrank by 0.9% in the second quarter between April and June. The GDP shrank 1.6% in the first quarter. What sectors are shrinking, especially given what you just said about profit reports not being as bad as expected and the market responding somewhat positively to what on its face seemed like not good economic news today? And what sectors are doing better than expected?
Well, 2/3 of economic output's tied to consumer spending, and the consumer is holding up. So, you know, that's why you have, I think, better than expected earnings reports, or just earnings reports that certainly weren't as bad as had been feared. What we have seen, I think, are some unique aspects. In the first quarter, GDP shrank because of the trade deficit. We exported very little, but imported a whole lot. Well, that's not a sign of weakness here. That's a sign of weakness overseas. The second quarter, that's, you know, a little bit more concerning. I mean, even then, the consumer held up quite well, but we did see pretty notable pullbacks. Inventories, you know, we had the big retailers that kind of got flat-footed as consumer taste shifted from goods to services. Well, they bought a whole lot less inventory in the second quarter. That was the biggest drag on GDP. Residential investment, home building, that was another big hit. You know, as we've seen the housing market certainly cooling very fast. And then government spending was down as well. So those were really the three detractors from the GDP. And it was enough to push in the negative territory, particularly that inventory aspect.
And Greg, we've seen that investors are unfazed by the Fed's latest rate hike. It could have been just because it was expected. But while economic experts are still predicting a recession, many of them, why are we seeing a positive uptick, though, in the stock market after the expected rate increase?
Well, there was one phrase that Chair Powell used yesterday that is maybe getting a lot of mileage, but I think it might be a little short-sighted to do so. Chair Powell acknowledged the slowing economy, and he said that at some point it will be necessary to dial back the pace at which they're raising interest rates. And so that's what investors really gravitated towards. But 2 minutes before that, he said that another one of these 0.75 percentage point hikes could happen in September, depending upon what the data says over the next couple of months. So I think this is some of investors hearing what they want to hear and just kind of, focusing on one aspect of what he said, not both sides of the coin.
Greg McBride, thank you very much.
Thank you.